Exxon Mobil out with first quarter results this morning. The company earning $2.06 a share for the first quarter. That was shy of the consensus estimate of $2.20. Revenue did beat expectations, though, at $83.1 billion. And joining us right now for an exclusive interview is Darren Woods. He's Exxon Mobil's chairman and CEO. And Darren, welcome. Thank you for being here today.
Good morning, Becky. Good to be here.
So why don't you talk a little bit about what happened during the quarter? The stock is off by about 1.4%. Revenue was stronger than anticipated, but the earnings per share was below what the street was looking for.
Well, if you look at the business and our operations, they delivered exactly in line with our plan. In fact, in some cases, they outperformed. You can see that in our cash flow from operations, which exceeded consensus by about $1 billion. The miss the street had for our earnings are a function of some non-cash tax and inventory adjustments, which we tend to see quarter on quarter occasionally, and this quarter they happen to stack up. But we feel really good about the operations and what the business is delivering.
One of the highlights that you point out is the gross production numbers that you're seeing now in Guyana. 600,000 oil equivalent barrels a day there. I mean, that has turned out to be a hugely important stake for you.
Yeah, it's, I think, a great example of the capability of this organization and each of the different sectors coming together, our technology company, operations company, our projects company coming together to make these things possible. We deliver these projects at an industry-leading pace. We deliver them ahead of schedule, below budget. And when we bring them on, the operations teams start optimizing, and we tend to reset what we think is possible and very safely raise the production to a point where we are now running those three ships, those production units at a rate higher than what we made the investment decision on. So extremely proud of that. Of course, we've got 3 more in the works I feel really good about. So this is a tremendous example of what the organization is capable of doing. But
the production that you've seen in Guyana is, I'm sure, part of the reason that you're involved now in this arbitration with Chevron. Chevron wants to buy Hess. Hess is a 30% partnership in that deal with you. You guys have a 45% stake in it. What's the arbitration over, and what do you think is likely to happen here?
So I think great context for that discussion. And if you look at Guyana and the development there, I think it will go down as one of the best deepwater developments in the history of the industry. So a lot of value that's been created through the hard work of the partners, but specifically with our engineering organization and our projects organization. So understand why Chevron's interested in participating in such an attractive development. The partnership that exists today is run or defined by a joint operating agreement. That agreement gives existing partners rights when there are changes in controls. The Chevron Hess transaction ignored those rights. We're standing up for the rights to make sure that we protect the value that we've created there, to make sure we understand what the Guyana assets, the value of those assets are in the Chevron Hess transaction, and make sure that we have a line of sight to how best to optimize value for our shareholders.
I'm sure you understand Chevron's position. I'm sure they've explained it to you. They are saying that there's a Hess subsidiary that won't change, and they think that that is enough to satisfy what they're calling a contract language dispute. That they think is something that's routinely put in and usually is not taken up by the other partners. How is this different, and how do you think it'll play out?
Well, I am familiar with their argument and their interpretation. We wrote the JOA, so we have a pretty clear line of sight as to the intent and the circumstances that apply and the language that applies to these circumstances. So we feel pretty confident in our interpretation. And frankly, that's the point of the arbitration. The JOA allows for that. It's understandable that partners from time to time can have a different interpretation of that. We'll take it through the arbitration process, and we'll let the facts speak for themselves.
Would you put in a bid yourself if arbitration allowed you to do that? You guys are still caught up with Pioneer Natural Resources trying to digest that major acquisition. Would you have the money to go ahead and try and put a bid in for these assets as well?
I've made it clear in the past that this is not a play for Hess. We're not interested in a transaction on Hess. This is really around protecting the value that we've created as part of that development, making sure that the preemption rights that we believe exist in the JOA are recognized and confirmed, and then understand what the value they're putting on that asset is, and then what the options are to maximize the value to their shareholders. So
What does that mean, Darren? I'm sorry, just to
that.
dig into it, does that mean you're not looking to buy Hess outright, but you would be looking to buy these assets, or you just want to be compensated and maybe push for a higher deal for those assets where you guys are compensated as well?
I think there are a lot of options on the table, Becky. I'm not limiting myself to any one. We're going to look and see what the cash value of that. First of all, we'll confirm the rights of preemption, and then we'll look to see what the cash value of this asset is within that transaction, and then we'll explore the opportunities that are available to us.
Darren, while you're here, definitely want to talk to you about what you're seeing in the demand for oil these days. We've gotten a few concerning numbers. That GDP number that was below expectations yesterday. There was a lower than expected manufacturing index number. Are you seeing any sort of a slowdown, and what do you see on the global stage?
No, I would tell you, actually, the first quarter was stronger than, frankly, we had anticipated. And so the first quarter looks good as we look forward through the rest of the year. Our expectations, we're going to see demand growth for oil. Probably hit another record this year. Last year it hit a record. This year we expect it to hit another record. Transportation fuels demand is very healthy. In fact, if you look at the first quarter refining margins that make petroleum products from crude, it was the second highest first quarter margin we've seen over the last 10 years. So a very constructive first quarter for refining. We're in a dip now as we head to the transition to the summer driving season. So we'll see how that picks up going in. Nothing indicates that that's coming off. The crude markets look fairly well supplied, but balanced. Natural gas is a little long right now, but I think that's a short-term issue. The one market that we see some weakness in from a margin standpoint is chemical, and it's not a function of the demand and the demand growth. It's a function of the supply that's coming on. So, frankly, we see a relatively positive outlook for the businesses that we're in our industry.